Good day, friends. Before we begin, please like and subscribe to stay up to date with the latest analysis. Something happened in the spring of 2025 that Wall Street did not see coming. Not a market crash, not a Federal Reserve decision, not a corporate bankruptcy. Something quieter, and in many ways, more alarming. Canada, the country that shares the longest undefended border in the world with the United States, the country that has been America's single largest trading partner for decades, the country whose financial system has been so deeply integrated with Wall Street that separating them would have seemed almost physically impossible. That country picked up the phone, called its bond dealers, and told the Americans they were no longer on the list. No dramatic press conference. No hostile legislation. No angry speech at the United Nations. Just a bond deal. A $2 billion bond deal that went out to Barclays, BMO, CIBC, and Scotiabank, and not one single firm from Manhattan made the cut. If you've been watching financial markets and wondering why the mood has shifted, why there's a new kind of tension in the relationship between the U.S. and its northern neighbor that goes beyond tariff headlines and political rhetoric, this is the story you need to understand. Because what just happened in the Canadian bond market is not a financial footnote. It is a signal. And signals of this kind, when they come from the country that is supposed to be your closest ally, mean something. Stay with me through this entire video because by the end, you are going to understand something that most people watching financial news are completely missing. If this kind of analysis is valuable to you, subscribe and turn on notifications because we track the stories that move markets before most people even know they're moving. Let's start with the mechanics, because understanding what actually happened is the only way to appreciate what it means. Ontario is not a small player. This is Canada's most populous and economically powerful province. Home to Toronto, home to the country's financial sector, home to massive auto assembly plants for Ford, General Motors, and Honda. When Ontario needs to fund its operations, its hospitals, its infrastructure, its public sector, it borrows money on the bond market at a scale that puts most U.S. states to shame. The province was planning to borrow somewhere in the neighborhood of $60 billion in its current fiscal year alone. A significant portion of that, roughly a third, has historically come from foreign markets. And for decades, when Ontario went to raise money in foreign markets, Wall Street was the first call. American banks like J.P. Morgan, Bank of America, Goldman Sachs, and Citigroup had been consistent underwriters of Ontario's U.S. dollar bond deals for over a decade. This was standard operating procedure. This was just how things worked. Then in June 2025, Ontario issued a $2 billion U.S. dollar bond, and the list of underwriters had no American names on it. Barclays from London, BMO and CIBC, and Scotiabank from Canada. That was it. The first U.S. free bond issuance from Ontario since 2011. 14 years of routine business ended without a single public announcement. You have to understand what underwriting a bond actually means to grasp why this matters beyond the political symbolism. When a major bank underwrites a bond deal of this size, it earns significant fees. It manages the distribution. It places the securities with institutional investors. It gets its name on the transaction, which carries prestige and cements relationships. Being on an Ontario bond deal is not a minor piece of business. It is exactly the kind of steady, reliable, high-value work that represents a significant line item for the investment banking divisions at the biggest American firms. And now, that business has moved. Not to a competitor across the street, across the Atlantic. What you might be asking right now is whether this was just a business decision. Maybe the European banks offered better terms. Maybe it was purely about price. Ontario officials, when pressed on the issue, did not use the word boycott. They said the decision was based on the best available terms in the market. But here's the thing about the world of sovereign and quasi-sovereign bond issuance. When a government entity has been working with the same group of banks for over a decade and suddenly restructures its entire underwriting syndicate to exclude every firm from one specific country, that is not an accident. That is not a coincidence. That is a decision. Jamie Dimon, the chief executive of J.P. Morgan, acknowledged it publicly. He admitted his firm had lost a couple of deals due to the uncertainty created by the tariff environment. When the CEO of the largest bank in the United States is openly acknowledging that his firm is getting locked out of deals because of the political climate between the two countries, you are no longer in the territory of routine market dynamics. You are watching geopolitics move money. And the reason geopolitics is moving money traces directly back to the tariffs. When the current U.S. administration moved aggressively on tariffs targeting Canadian steel, aluminum, and automotive components, the assumption in Washington may have been that Canada would absorb the pressure, negotiate from a position of weakness, and ultimately make concessions. That assumption underestimated both the economic leverage Canada holds and the political resolve of Canadian provincial governments who were watching their primary industries get squeezed. Ontario's economy, at its foundation, runs on automotive manufacturing. When tariffs hit auto components, they hit the assembly lines in Oshawa and Windsor. They hit the suppliers, they hit the workers, and they hit Doug Ford's government directly in its political base. The response was not passive. Doug Ford's administration had already started deprioritizing American companies in public procurement contracts, a move that was significant on its own, but felt like a warning shot compared to what came next. When you tell every American firm that they are at the bottom of the list for government contracts, you are sending a message. When you remove American alcohol from provincial liquor stores, you are making headlines. But when you take a $2 billion bond deal and hand it to London and Toronto instead of New York, you are hitting a different nerve entirely. You are going directly for the fees, the relationships, and the influence that American banks have spent decades building. The message being sent through that bond deal was precise and deliberate. If American tariffs are going to tax Canadian exports and threaten Canadian industries, then American banks should not expect to profit from Canadian debt. It is a form of economic retaliation that is sophisticated, targeted, and extremely difficult to reverse once the relationships with alternative underwriters have been established and proven to work. Because here is what Ontario demonstrated with that June 2025 deal. The sky did not fall. The bond was issued successfully. Investors bought it. The capital was raised. Ontario proved in the most concrete possible way that it does not need Wall Street's blessing to access global capital markets. Barclays and the Canadian banks got the deal done. And once you prove that something works, you have changed the calculus permanently for every future deal. Now look west, because Ontario is not alone in this. Alberta moved first, actually. In March 2025, Alberta issued a euro-denominated bond worth 1.25 billion euros. Bank of America, which had been involved in Alberta's bond issuances for the previous 6 years, was not on this deal. Barclays, RBC, and TD handled it. Alberta's government, when asked about the exclusion of American banks, offered official language about competitive pricing and market conditions. But the timing, coming directly in the context of escalating U.S.-Canada trade tensions and the pattern, matching exactly what Ontario did 3 months later, makes the diplomatic explanation difficult to accept at face value. Alberta is a province whose entire economic identity is built around energy. Oil sands, pipelines, export revenues. The province is heavily tied to commodity cycles, and it has spent years cultivating relationships with international investors to support its energy infrastructure. When Alberta pivots its bond financing toward European banks, it is not just making a statement about tariffs. It is building relationships with a new category of financial partner that operates by a different set of rules and priorities than Wall Street does. Those European lenders bring something with them that American banks typically do not lead with: ESG mandates. Environmental, social, and governance criteria are baked into how European institutional capital operates. For Alberta, an oil-heavy province that has historically pushed back against aggressive environmental regulation, this creates an interesting tension. The capital may be cheaper or more accessible through Frankfurt and London, but the lenders who provide it are going to have opinions about what that capital is used for. That dynamic is not settled. It is evolving, and it introduces a new variable into Alberta's energy sector planning that was simply not present when the primary financial relationships ran through Houston and New York. Beyond the bonds themselves, the pivot in Alberta is showing up in logistics and export strategy. Tanker routes that historically fed crude southward into the American refinery system are being reconsidered. New pipeline corridors and export terminals oriented toward Pacific and Gulf markets are under development with financing structures that are increasingly backed by European and Asian institutional investors, rather than American ones. The money following the oil is no longer exclusively American, and whoever holds the financing for an industry holds leverage over the direction of that industry. This is the piece of the story that most financial coverage does not spend enough time on. The bond deals are the visible, measurable signal, but underneath them is a deeper shift in where Canadian industries are building their financial relationships for the long term. Relationships in finance are not switched on and off like a light. They are built over years of transactions, of trust, of shared risk. When Canadian provinces start doing consistent business with European banks, those banks start learning the Canadian market. They develop expertise. They develop appetite. They become the natural first call for the next deal. Displacing them later, even if the political environment between Canada and the US normalizes, becomes progressively harder. Wall Street's position in the Canadian market was not built overnight. It was built through decades of showing up, doing the work, earning the fees, and making itself indispensable. That position is now being deliberately eroded, and the erosion is happening at exactly the moment when European and Canadian banks are most motivated to prove they can fill the gap. Let's talk about what this means at ground level, because it is tempting to treat this as an abstract financial story that lives entirely in boardrooms and on trading screens. But the implications of a structural shift in how Canadian provinces finance their operations reach down into the real economy in ways that are already visible. Ontario is home to assembly plants that produce vehicles for the North American market. Ford, General Motors, Honda. These are not Canadian companies. They are American and Japanese multinationals that have chosen Ontario as a manufacturing base because of its skilled workforce, its proximity to American markets, and the integrated nature of the North American supply chain that was built under NAFTA and its successor agreement. That integration assumed a cooperative economic relationship between the countries. It assumed that goods, capital, and services would move across the border with minimal friction. Tariffs break that assumption. When auto parts get taxed crossing the border, the economics of running an integrated cross-border production system change. When the provincial government that hosts your factories starts openly deprioritizing American suppliers in its procurement, you start modeling scenarios that you never had to model before. When the financial infrastructure that has historically supported the province's borrowing shifts away from American institutions, the signal to every multinational operating in Ontario is clear. This is not business as usual. The rules are changing, and you need to account for the new rules in your planning. Supply chain managers at these facilities are already dealing with added complexity. Canadian steel moving to the top of supplier preference lists, while American inputs get pushed down, means procurement patterns that have been stable for decades are being recalibrated. It means contracts being reviewed, supplier relationships being renegotiated, and lead times being recalculated. It is friction. Deliberate, politically motivated friction. And friction has a cost that shows up in the operating margins of businesses that cannot easily absorb it. For smaller businesses in the supply chain, the machine shops, the parts fabricators, the logistics operators, the uncertainty is more acute. A tariff environment that changes the competitive calculation between sourcing from the US versus sourcing domestically, or from a third country forces decisions that were never supposed to be necessary. Companies are spending management time and capital evaluating supply chain alternatives that would have seemed irrelevant 18 months ago. That time and capital is not being spent on growth. It is being spent on defensive repositioning. There is a broader signal in the Canadian institutional investor community that deserves attention as well. The largest pension funds and institutional investors in Canada, organizations that manage hundreds of billions of dollars, have begun publicly discussing a reconsideration of their U.S. exposure. This is not panic selling. The capital flows between Canada and the United States remain enormous, with hundreds of billions of Canadian money still parked in American assets. But the framing has shifted. What was previously unquestioned, that American markets are the default, that U.S. dollar assets are the anchor, that Wall Street sets the tone, is now being examined with a more critical eye. When institutional investors start asking whether their U.S. exposure is appropriately sized, that is a meaningful change in sentiment. Sentiment in capital markets has a way of becoming self-fulfilling. As Canadian institutions build out their European and Asian investment relationships, as they develop comfort with non-US market infrastructure, the natural gravitational pull of American markets weakens incrementally. Over months and years, incremental changes in sentiment and allocation compound into structural shifts. The US dollar is the invisible architecture underlying all of this. The Yankee bond market, where foreign entities issue US dollar-denominated debt in American markets, exists because of the dollar's reserve status and its liquidity. When Ontario issued its June 2025 bond in US dollars but excluded American banks from the deal, it proved something significant. You can access US dollar capital markets without going through Wall Street. The dollar remains the currency, but the American financial institutions are not necessarily the intermediaries. That distinction matters. It means the leverage that American banks derive from being the gatekeepers of dollar-denominated financing for foreign issuers is not as absolute as it appeared. This is a long game. Nobody is suggesting that the Canadian bond market pivot immediately ends the dollar's dominance or permanently restructures the global financial system, but the direction of travel is visible. Each successful bond deal done without American underwriters adds another data point proving the model works. Each procurement contract awarded to a European or domestic supplier instead of an American one builds the relationship that makes the next such contract easier. Each year that passes with European banks deepening their expertise in Canadian provincial finance makes their presence more durable and American banks' absence more normalized. The question that should be keeping strategists at American financial institutions up at night is not whether Canada's current moves will cause immediate pain. The fees lost on a handful of bond deals are manageable for firms of this size. The question is what the trajectory looks like 5 years from now if this pattern continues. If Ontario and Alberta establish European and domestic banks as their primary underwriting relationships, if Canadian procurement officers build durable preferences for non-American vendors, if Canadian institutional investors normalize a more diversified allocation away from the U.S., the cumulative effect is a North American economic relationship that looks fundamentally different from the one that existed in 2024. And the leverage to reverse it diminishes every quarter it continues. So what is actually at stake here? Stripped of all the financial jargon and geopolitical framing, what does this mean for the ordinary person watching this? It means that the assumptions baked into the North American economy for the past generation, that goods, services, and capital flow freely across the US-Canada border as a matter of default, are under active revision. It means that American businesses that relied on access to the Canadian market as a given are discovering that access is conditional. It means that Wall Street's role as the indispensable financial partner for Canadian borrowing is being challenged in a way that hasn't happened in decades. For American banks specifically, the message is stark. You are not irreplaceable. European banks can do this work. Canadian banks can do this work. The market will function without you. That is a message the largest firms on Wall Street have not had to hear from their closest neighbor in living memory. For the broader U.S. economy, the question is whether this is a temporary disruption caused by a specific policy moment that will normalize when trade tensions ease, or whether Canada is using this moment to make structural changes to its financial relationships that outlast the specific political circumstances that prompted them. Based on what has happened in Ontario and Alberta, based on the deals that have been successfully executed, based on the procurement policies that have been put in place, the answer increasingly looks like the latter. Canada is not panicking. Canada is repositioning, calmly, methodically, and with considerable strategic sophistication. The panic, if there is going to be any, belongs to the institutions and industries on the American side that are watching this happen and asking themselves how long it continues and how much deeper it goes before something changes. Washington has not yet offered a response that matches the seriousness of the signal being sent. Diplomatic language about the importance of the bilateral relationship continues. Negotiations around trade continue. But the bond deals have already happened. The procurement policies are already in place. The relationships with European banks are already being built. Words come later, capital moves first. And in this case, the capital has already moved. If you want to stay ahead of financial and geopolitical stories like this one, stories that move markets before they make front pages, subscribe and hit the bell. Leave a comment below telling me where you are watching from and what you think the US response should be. I read every comment and it shapes what we cover next. And if this gave you a clearer picture of what's actually happening between Canada and the United States right now, share it with someone who needs to understand it, because this story is going to get bigger before it gets resolved.